Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at Cardo AI. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Paul Lisiak, Managing Partner and CIO of Metropolitan Partners Group. Paul, it's great to see you. Looking forward to our conversation.
Thanks, Todd. Very excited to be here.
So, if we think about, Metropolitan, I know you guys talk a lot about generating returns through three premiums, which is access, complexity, and work. Maybe if you can, for the purpose of our listeners, unpack that and tell us a little bit more about, Metropolitan as a whole.
Sure. So, Metropolitan, we operate in the lower middle market doing non-sponsored deals. We're senior secured debt, but we really work with our target portfolio companies by, talking about capital solutions. We're very much always looking to solve problems through capital and create value and share in that upside. Typically speaking, when we find companies, they're usually struggling from kind of one of three issues. That could be access to capital, being too complex, or basically they just haven't prepared themselves for institutional markets. Therefore, an opportunity to invest kind of requires a lot of work. So we basically view our portfolio basically across three premiums, and we're often looking to try to find ways to, again, deliver a capital solution. Under an access premium situation, typically the borrower lacks sophistication and a network. Perhaps they have a great accountant CFO or even just a head of accounting, but don't really have a savvy CFO that you'd find in a sponsor-backed business. So as a result, very often it's not really a pitch that they're actually giving for capital, but really describing their problems and or opportunity. And with that, basically, we're often hearing words that, like it'd be the perfect wrong time to sell equity. But we need capital to march our business forward. Can you help us? Other times we have situations that are just very complex. Could be esoteric assets, could be an asset-rich business, but it's structurally fragmented because they don't have a great corporate org chart, or there's other unique microeconomic dynamics happening. And with that, basically, we often hear the words of things are not as complicated as they appear, but it does take some effort to get there. And then other times just brute force. I mean, work premium, there's sometimes businesses just don't come prepared. And even if they know a lot of capital sources, They have fragmented accounting, fragmented financials. We're just reporting to themselves. So perhaps they have opaque balance sheets or something else that actually is harder to find asset value without doing a lot of work. In those situations, we roll up our sleeves and really try to unpack the situation and try to find, great assets and great management teams that, again, just need a little bit of effort to underwrite and determine the right path forward for them in the capital markets.
Yeah, obviously most of the money that's gone into private credit has gone towards the sponsor backed opportunities. And I guess two questions on that. What's kind of been drive or has driven that capital going there? And is that, would you consider that the easier path, the sponsor backed path?
I think historically it was the easier path. Again, you have a lot of very smart people that are well organized, helping find alpha in private businesses and taking large ownership stakes and taking those businesses through a traditional institutionalization, which then allows for a very easy package wrap, opportunity for a private credit fund to come in and provide leverage for that private equity sponsor to enhance their returns and to drive a business forward. That market's obviously become a lot more crowded today,
Hmm.
and good deals are super competitive because there's just been, like, to your point, a lot of flow of capital into the middle market and upper markets. Therefore, you have a lot more firms competing for the same number or potentially even less, good deals in the market today.
Do you think that kind of flood of capital into either the upper middle market or even the upper cap has actually improved opportunities for you guys in the lower middle market?
For us, definitely. A lot of our friends and competitors that were in the lower middle market have started to drift up to the middle market, started doing more sponsor deals. What we do is very labor intensive to the prior conversation about premiums. Traditional asset management model is to raise more capital. And
Yeah.
if you raise a lot more capital, you do need to drift into larger deals. And just by definition, those larger deals have more competition. So ironically, the flow of monies that have gone into the middle market have actually allowed us to actually have less competition for great deals down here in the lower market.
Do you guys ever get like, enticed to kind of go upper market, or is the ethos to kind of, stay where you guys have been successful and know how to, as you say, do the hard work on some of these deals?
Yeah, I think our ethos is hard work. We've been doing this now for over 16 years, and we've trained ourselves to work hard. And it's been a long time to grow our firm to 1.9 billion of assets under management, and we're pretty happy with the opportunities and the alpha that we're achieving down here relative to risk. All of our deals are underwritten with a loan to asset value as opposed to loan to enterprise value. And typically we're looking at a 65 to 70% loan to asset value. Looking at that and the alpha we can generate for ourselves as LPs in our funds, separate apart from the great returns we're delivering to our LPs, we're in a very comfortable place, and we're frankly investing more money in our own infrastructure to continue to broaden the team and bring in new AI tools and other efficiencies to allow us to do more deals under a similar size range that are below the radar screen of larger, more traditional direct lenders.
What is the fishing hole framework, and practically speaking, what does that process look like?
Sure. So yeah, we do use the analogy of fishing holes internally here for different niches. The concept was actually given to us by one of our LPs that asked me a question many, many years ago. Paul, is Metropolitan a better fisherman at a well-fished fishing hole, or are you a better finder of underfished or unfished fishing holes? And I
Hmm.
couldn't hedge my answer. Of course, we believe we're good fishermen as well, but I think the ethos of the firm is to really be able to find new fishing holes and go where other capital is not. And basically, the overall supply demand economics that you get by unlocking new niches or going to niches where a lot of other institutional investors are not really does offer us great opportunities. So we're constantly doing research to find new fishing holes. Sometimes that's proactive through macro dynamics that we then unpack and basically find microeconomic opportunity. Other times it comes to us in a deal where a new sector, a new niche comes, and we see certain hooks, so to speak, of why we should like an opportunity in that niche, but pass on that deal, but then kind of build a research team here to go off and unpack it and build up an expert network to ensure that we know what we're doing there and we understand the laws of gravity, as well as finances, that allows us to kind of bring our capital solution to a new fishing hole.
You guys have done things from aerospace suppliers to title agencies. What ultimately gives you the conviction that, you can, properly underwrite these businesses when there maybe some other lenders be like, this is too much work, too much of a struggle, or something that we're not too comfortable with.
Totally fair. We do transcend a lot of different niches. And again, being a loan to asset value lender, it allows us to be a little bit less precise, perhaps, than a super competitive middle market deal where everything's priced to perfection. I mean, going back to the premiums, we underwrite a deal really looking at our downside protection in those assets, utilizing our own internal skills as well as our operating expert network that we've built ourselves, and really focusing in to ensure that we understand the intrinsic value of the assets that we're financing and how we would be able to take delivery and protect the downside for ourselves. That overall ability basically can transcend different niches. Of course, we need to understand what else is going on and macro factors that could address or could affect different niches. But overall, we're basically looking to arbitrage microeconomic inefficiencies. And that's actually relatively easier to do when a business, again, is lacking access, is too complex, or just requires a lot of work to underwrite and get capital into a business. So, not to be as trite to say throwing hand grenades versus sharpshooting, but that overall dynamic allows us to be a bit more flexible to go where the microeconomic opportunities are, as opposed to trying to be super deep in just one overall sector or area of finance.
Does it take you significantly longer to do a deal than, say, your typical sponsor-backed deal? And what does that time frame look like? 8 months, 10 months, a year?
No, unfortunately, we need to work a lot faster. Again, non-sponsored businesses are typically not well prepared to access
Got it.
capital. So there's often some type of time sensitivity to situations. And so as a result, we need to be very efficient. So, again, we overstaff deals. And when we find a deal that we like and that has the downside protection, but yet also a positive use of our capital. So we're really looking for marginal revenue productivity of the debt that we put into businesses. And so we have that dual dynamic of downside protection, yet basically catalyzing and creating good value. We overstaff the deal and try to get a deal done in as fast as 60 days, up to maybe
Hmm.
120. But our deal team is measured on their efficiency without actually, cutting corners or being hasty. But the overall kind of convenience arbitrage of our team getting to yes is something which is a very unique attribute of Metropolitan, as we believe part of our thesis as to how we operate and why we have such a large team is that we believe overall a lot of financial investors underestimate the opportunity cost for private businesses accessing capital. And they even exist in the middle market, but as you come down to lower middle market, even looking to, startups and other things that we don't do, just the opportunity cost is very high. And
Yeah.
so if we're showing a get to yes approach and we can be efficient with a business owner's time, they're willing to often overpay for that because they can make it up in getting back to business and not spending all their time raising capital. So it is one of the things that we do try to do. And that type of empathy and understanding of the opportunity cost of their time is something that definitely builds a lot of strong relationships with our borrowers.
Obviously we talked before about the capital going into the upper middle market and even to the larger transactions. As capital begins to find new areas and maybe come down market as the upper market begins to get crowded out, how do you kind of preserve that edge that you guys have built to avoid some of the same crowding coming to maybe some of these other more niche areas?
That's a very interesting question. I mean, again, the skills to operate down where we exist are a lot more multifaceted. Again, we're sourcing our own transactions. We've done close, I think it's almost 180 transactions at this point, and over 80% of those have been sourced without banks or brokers. So having the network to find the right opportunities is key. That's very much relationship driven. And then having that reputation of being empathetic and understanding that things aren't going to be perfect, you need to have a little bit of a different approach. We'd welcome more competition to come down, but if they're looking to do the similar type of diligence that's prepackaged for them in the middle market, they'll have some surprises relative to a little bit more of elbow grease that is required to to unpack these situations and structure something that basically is appropriate to align interests with these owner operators who typically have 80 to 90% of their net worth in a business. And so that type of counterparty acts a lot different from a professional management team with the sponsor business, which is obviously very well qualified, very experienced, but they're playing for option pools and MIPS. They're not playing for their net worth. And so it's a little bit of a different poker game.
Hmm.
And again, we believe we have the track record of showing that empathy and again helping deliver capital solutions and sharing in that value creation.
What's usually the biggest impediment that you guys face? Is it just like the people aren't prepared for the institutional capital that might come their way or they might be interested in gaining access to? It's kind of like a mismatch in talent. Like they have the drive to build their business, but maybe they don't have the right skill set to necessarily acquire institutional capital, something else.
Yeah, so we actually run something internally called the Ten Commandments, and the number one commandment is skin in the game. And so we very often find people that have great opportunities, but just don't have enough skin to put in the game. And so we correlate skin in the game with success. And so a management team that shows up, that's put a lot into the business, both hard dollars as well as time,
Hmm.
and obviously has the track record of operating that business. That's very important. So we do often see situations that are very interesting, but we just don't know if we have a counterparty. And if we don't have a counterparty that has skin in the game, that's harder for us. We also see a lot of situations now where people are coming and saying, "Hey, we would like to do a deleveraging transaction." And again, we're not in the business of doing that. We like to see our capital being applied to value creation. So we've seen a lot more refinancing opportunities, which just don't play for our cost of capital and don't play for how we like to work with companies.
Obviously, you guys, make a point to say that you help finance the real economy versus the financial economy. A, is there a clear definition of what that is? And secondly, are there any particular sectors within the real economy you think are, kind of really underfinanced?
Yeah, so we view the real economy as basically being fundamental value. That we separate that from the financial economy in either assets or situations that have already been productized. So we love a lot of niches and fishing holes where you have assets that could be securitizable if there were larger market opportunities and had more assets available for the financial markets to productize. So we like the attributes of those types of assets. So we've done things like niche royalties where it was the royalties of composers of non-vocal music in movies and television. And there was just a lot of them out there, and it wasn't really an asset class that yet hit the larger royalty aggregators. And so we were at the fishing hole before others, and we were actually able to go and do fundamental transactions and understand the reasons for the sellers. And in that situation, you had a lot of older composers that were kind of in the retirement age that were looking to monetize. So we had the right microeconomic dynamic, going on there relative to not forced sellers, but motivated sellers, and with the right team of people that knew the good from the bad at the asset level. So we, worked with an industry group that had lots of, historical operating experience there, and that was, an opportunity for us to go out there and solve real world problems and build a large asset pool, which then was packaged and sold to a larger aggregator almost as a financial product. So we really like to be on below the radar screen and working with, again, real world businesses that need fundamental capital to execute on fundamental value creation. So we've done asset aggregations and business aggregations in a lot of those situations with, again, similar dynamics. That whole silver tsunami concept where you have a lot of people that forgot to retire over the last 5 years and are small to medium-sized business owners. And again, they don't know how to access private equity. And frankly, the businesses are too small for private equity
Yeah.
firms to come down. So how do we live under real world problems and opportunities like that? So we really define the real economy as being those types of situations that are below the radar screen of traditional investors where a lot of LPs are allocating.
Is there a misconception that the smaller or lower middle market borrower is inherently riskier than the larger sponsor backed company?
I heard a quote recently that someone said, "Oh, people are realizing there are new risks in private credit," and the answer is, "Well, there's always risks in private credit. They're just recognizing them
Yeah.
today." Look, there are definitely different dynamics that go on with non-sponsored businesses. We underwrite businesses as both a lender. We also look at business execution, almost like a private equity firm as well. And then we come up with loan documents that typically have 30 to 50 covenants, with 10 to 15 of those customized to the KPIs of the underlying business. And so in lieu of taking a board seat and trying to tell them what to do, we have a rules-based system, and that rules-based system with lots of covenants, that has to over monitor and govern the relationship. So in the limited market, you do need monthly reporting. So all of our portfolio companies do report on a monthly basis, and that really is helpful because you can start to see at the KPI level when things break down. So you're not waiting to the end of a quarter where then there's
Hmm.
fancy financials and then you get them 30 to 45 days later. You're inside the plumbing. And so while there is definitely more risk relative to a smaller business being able to execute, at the same time, they have more opportunities typically to be more nimble and to execute against contracts or acquisition opportunities, things that actually are step change events for them, that basically really are not less risky, but they're just not priced to perfection. So we are getting paid for that over monitoring and the management. And then again, internally have the skills that should that business execution not occur, that we can, basically monetize assets and recover value for our capital. So under the auspices of asset value protection, I would argue that we have less risk because we have more downside protection than loaning to enterprise value, where you're typically loaning, 40, 50% of that enterprise value. But
Yeah.
yet, if the business doesn't work, there's either negative beta or black swan events. Basically, you don't have a lot to fall back on. You are kind of dependent upon the capital markets to be there to protect yourself as a lender to a larger sponsor-backed business. So it really all depends on what you're looking to achieve. Our goal is not to deploy a ton of capital. Our goal is to deploy the right capital in the right situations with that asymmetrical upside opportunity, with basically labor underwriting the downside protection. We do all of our own workouts. We have our own internal team of 9 people that monitor our 52 company portfolio, and we have 2 workout people, full time on staff. So we're ready to deal with challenges as they come up, as they inevitably do.
We'll come back to workouts in a minute, but I know you've touched on AI a couple of times through the conversation. Curious, obviously, there's been a lot of conversation around the AI disruption and what it means for private credit and obviously software heavy portfolios. But I'm more curious, like, how have you seen the AI disruption come down to the lower middle market where there might not be an obvious tie-in if people are thinking of some of these companies we mentioned before, that AI disruption coming down to where you guys play in the market?
Sure. So, as we look at, different fishing holes, we do try to, we've been doing this for about the last 12 months, categorizing them to be, either AI immune or basically AI susceptible or basically, AI, super threat or even AI opportunity. And we have done a couple of deals where AI is unlocking value, notably in data sprawl, and really allowing a lot of typically manual processes to be more automated. And so, if you have the right team that's on the right side of AI expertise and applying AI, you actually have some great opportunities in the low middle market. But I'd say more than half the businesses that we finance, fall into that somewhere between AI immune or AI is a small optimization tool. It's not going to be a step change, for them. But again, back to the real economy, there's just a lot of business and sectors that you can finance out there that are not under the same threats that you do, you read about relative to software companies and things like that. From a firm standpoint, AI has been an incredible tool for us. As you can imagine, relative to the breadth of sectors that you've mentioned in fishing holes, we do have a lot of disparate data and different types of data that we deal with. So monitoring, 50 plus companies each month across multiple data points,
Yeah.
we do need to have good tools to capture that data and analyze it. So AI has been an incredible tool for us to improve efficiencies in that regard. There's been some AI efficiencies relative to research and some aspects of underwriting, but
That's gonna be my next question, the research part, because I figured the whole fishing hole and finding niche areas that AI can maybe help at least identify areas to maybe look at versus, finding the area to invest or lend to. Maybe it just points out an anomaly or something.
yeah, I think the word finding is really a great word there. Finding the right research, finding the right attributes, but again, human in the loop and basically
Yeah.
having a smart human at the other end of that. We've never outsourced any of our actual hard work to AI, relative to the analysis, but data gathering, data collection, data frameworks and things like that.
Yeah.
It's been very, very good for us. But like I don't see AI doing much at all on the sourcing side. Again, we're looking for microeconomic data points, and again, back to the skin in the game. There's a human element and the empathy to what we're doing, and nothing can really replace looking a portfolio company CEO in the eye and basically working with them on a solution and seeing their conviction, and then basically trying to build a relationship with them that really drives transparency. And so a lot of that cannot be accomplished through technology. But and even like on the workout side, there's it's so dynamic and so unique. Sure, there might be some tools to help, but the fact that we already know these companies and we're doing our own workouts, we don't have a data collection issue there. We just need a smart person that understands the assets, understands the backup plan, and understands the legal mechanisms for us to protect our capital.
Right into my next topic, which is workouts. Is there enough transparency around workouts, and ultimately why is that important?
I think, yeah, transparency is key. Again, while we're getting monthly reporting, we have a little talk off that we give all of our portfolio companies, CEOs and CFOs, which is, hey, we're your partner in this situation. While we're not equity, basically we want to be accretive. We want to be empathetic, but we can't address things that we don't know. So if you're transparent with us, we'll always give you a second or maybe even a third chance. But if you play hide the ball, or things aren't as
Yeah.
transparent to us, you just give us less options. If you delay a problem too long, it becomes a bigger problem. I love giving this example. We had a portfolio company, and I had known the CEO from a prior life, and I gave him my talk off. I was like, look, come to us, you have problems, because we want to be solutions oriented, and the sooner you come, the more we can help. And I've received an email on Christmas Eve, subject line, "Sorry to ruin your Christmas." And he went through the situation saying, I don't know how bad it's going to be for this month, but a couple of mini events occurred in the business, and we're going to miss numbers by a mile this month. And I'm really sorry again, but I'm leaving for vacation, and I just had to get off my chest because you asked me to be transparent. And while he CC'd a few people on the email, I jumped right above and I said, thank you, so and so. This is the best Christmas present you can provide me, which is a gift of transparency. Stuff happens, and stuff happens in low mid
Yeah.
market, as well as all markets all the time. I'm like, go enjoy your vacation, go relax, recharge your batteries, let the month play out. And once you have, initial arms around the situation and the numbers, we'll come to you, you come to us. Let's sit down in a conference room. Let's figure out what to do together. And sure enough, Jan 10, Jan 15, we got back together. And within 2 months, the business was back, operating as smoothly as before. And had he waited until, January, February, March, and that problem kept getting worse, it would have been harder for us to be, as solutions oriented. So So we really do thrive on transparency. And then look on the rest of the workout side, it all depends on the situation. A lot of our LPs ask us, oh, what's the backup plan? Or, how are you going to get our capital back in this deal if things don't work? And I like to use the analogy of kind of asking a doctor, how are you going to treat my child next winter when he gets sick? First question the doctor's going to ask you is, what does he have? Right? I have a lot of tools in my tool belt here to solve a lot of
Yeah.
problems for your child, but you need to tell me exactly what's happened and et cetera, et cetera. So, we have all the skills internally to do it. Our legal documents are tight, so we have the right legal remedies when needed. But again, that's the backup plan to the backup plan. More often than not, we're not doing workouts, but desktop interventions where we're trying to reset the situation and get the business back into a position of growth, like I talked about with my Christmas friend, as opposed to jumping right to the workout. So, but look, we've done a bunch over the years, and it does require both expertise as well as a fair amount of labor. But we have a pretty strong track record when it comes to ensuring that when things happen, that we're not losing money when things go sideways or down.
Two follow-ups come to mind. One is, do you ever encounter like the Wall Street or fund, perception that maybe you guys are coming in to take the business and sell it for parts, and like, because regardless if you're credit or equity, I think there's a perceived notion of who you might be and how you might operate. And then the second question is, to your Christmas story, there is also the kind of trying to fix a problem too quickly, an issue when in reality, when things play out, the problem might not be either as bad, or the solution might unearth itself if you don't try to fix it like in real time and like try to fix
Right.
it yesterday.
Yeah, look, I hear that the second part there, but yeah, look, our the name of our firm is Metropolitan. While we have people around the country, the main office is New York. We make up for, coming from New York again with a lot of empathy. It does require us sometimes we're bringing on, new employees to remind them that, well, there's not a finance bro attitude here, and the last thing a successful 50-something-year-old needs to hear is some 29 year old telling them what to do.
Yeah.
It's still their job to underwrite, but again, using operating experts with also the seniority and the gray hair to come in, again, we're trying to be again much more empathetic, because again, we believe that's the best relationship to have, and have two-way communication and two-way transparency. But yeah, like it sometimes is harder. But again, most of our deals are outside of New York. We're investing all around the country. Um, and then, yeah, look, I mean, relative to how it plays through, longer term with these borrowers, we are looking to make sure they understand that we're at some point looking for them to have escape velocity, off of our capital. And we are looking to help them, like, get to the next level of success and repay us. Then we have warrants. Then we can then help them, be a we could be their de facto sponsor against new lenders or new private equity in the future, and we're on the right side of the table with those borrowers.
If we think, a few more minutes of kind of private credit, and then we have some fun questions. Um, are we starting to enter a period? I know the last few years there's been tons of money in, and scale has been kind of the name of the game, it feels like. But it feels like now we're starting to enter where like specialization starting to take over, and maybe a bit away from scale. But where do you see kind of that dynamic playing out?
Yeah. Look, so I mean, first and foremost, and I think some of your other guests have said this before, not all private credit is invented the same, right? I mean,
Yeah.
private credit's gotten so big that lots of niches are there within private credit. A lot of different reasons why certain private credit exists. In the upper markets, you have a lot of refinancing of prior loans, and again, financial engineering with private equity firms, and that's again been a great place to be for the last 15 years. The overall kind of fundamental, financing of businesses, that's been around since the history of time. And really, sticking with that kind of universal banking approach, we believe that differentiates us. But where the overall industry goes, specialization definitely is important. but I would put that as your overall approach to the capital markets being special, as opposed to just being in, say, one vertical. Obviously, a lot of AI data center financing is happening today, but you can go back in the history of time and see, different, kind of sector experts, and that's great if you want to catch the ride on the beta train. But we believe from a specialization standpoint, understanding how non-sponsored businesses work and doing loans to asset value is a specialization which can transcend lots of niches and really allow us to keep moving. But overall, there's been a very heavy flow of capital into private credit. The LP markets seem to be a little stuck right now with people expecting monies back from older funds, and that's coming back slower. But there's a lot of capital there, and a lot of new LPs are even showing up and starting to look around. But I think the free lunch that private credits provided relative to capital flows and declining rates over the last 15 years has abated over the last couple of years now, and
Yeah.
LPs are getting a lot smarter, and really asking a lot of well-refined questions as to how and why, not only Metropolitan, but my friends at other firms, and people are really saying that LPs are getting down to more brass tacks and not just looking for track record, or just an overall brand name. So I think there'll be an ongoing evolution of LPs as they get more and more sophisticated in the space, and do start to look at private credit as lots of different sub segments as opposed to private credit overall.
Speaking of LPs, I mean, are there any common misconceptions that they have about the lower middle market that you guys dispel them of when talking to them?
Uh, yeah, that's dispel is a tougher word. But look at it, but I think there's a lot of there's a lot of preconception that the lower middle market is riskier, and not having a sponsor is riskier. And what we try to position them to say is, like, we're a principal, in the transaction. We're typically the only capital in a capital structure, and typically speaking, we have a couple of management team members who are counterparty, which again they have majority of their net worth in the business. So when things do happen, you have principals at the table, solving it. And so what we do try to explain is that, in larger deals, you have syndicate of lenders, you have advisors, you have professional management teams, a lot of different pieces and parts that come together. And there's a lot higher transaction costs behind the scenes in those markets, versus in our market, we're basically, we're working on things ourselves in a very hands-on way. So look, people do think that there's a lot more risk in low middle market, and we don't disagree from a daily operating standpoint, generically speaking, in
Yeah.
low middle market. But overall, the asset protection that you can get in low middle market is something which I don't think people fully appreciate. Offers the right convexity of returns.
So we have just a few minutes left. I always like to end with some fun questions. So favorite sports team and or hobby?
Red Sox and golf.
What's the golf handicap?
Not good today. Been working too hard. It's an 11 index, up from a 7.9 a year and a half ago.
It's still pretty good. Still pretty good. One surprising thing about yourself.
I recently learned how to meditate.
Hmm. Was there any particular thing that said, "Hey, I need to do this," or is just just staying healthy and
A friend gave me a book written by Bob Roth about transcendental meditation, and I read it over Christmas time on the beach with my family, and came back and signed up for a course. And it's just a nice, relaxing thing to do twice a day.
one book that you'd recommend reading other than that book?
um, a very good friend of mine named Paul Craik recently wrote a book called Growth Without You. And it's all about AI and how that's going to affect work, wealth, and kind of just overall lifestyles. And so I'm about halfway through it. He spent 15 months writing it, and I joked that I was going to put an AI and it'll summarize it for me in 30 seconds. He said, please don't do that. I then accused him of using AI to write the book. He also said, no, you've known I've been doing this for 15 months. So
Uh,
a human did write it, and Paul's got great insights. So I'm working my way through that book right now.
most exciting part of your job.
Every day is different, new and unique, problems and opportunities to solve. And look, I really do enjoy working with business owners. And so big DNA over here is basically helping create value. Again, while we protect the downside, but again, our first job is to create value. So that's the most de-risking thing you can do.
And the final question, one prediction for the next 12 months.
Oof, that's a tough one. Well, I'll predict the Red Sox will not win the World Series this year.
I think
But
that's an
look,
easy one.
yeah, I think obviously, with all the capex, fueling a lot of pieces and parts of the economy, really looking to see how that could potentially have some unwind at some point. So I don't know if that happens in the next 12 months, but at some point there's going to be some reversal there, and we'll see who actually knows what they're doing there and who doesn't.
Well, Paul, I really appreciate your time. So thank you for coming on the show. It was a really fun conversation, and continued success to you and the team.
Thanks, Todd. Really appreciate it.
Yep. Thank you. So we have just a few minutes left. I always like to end with some thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.